Good to be with you here for live coverage of the FOMC interest rate decision just out in 10 minutes. So I have some live near-term charts up, guys. We'll be watching with the 5 minutes due as we get the release. Again, the devil's in the details. We're not going to get, it's not going to get those quarterly releases or anything, guys. It's going to be just the policy statement. So we'll comb through that policy statement. We'll see if there's any shifts. Remember, we've lost two dissenters or two known hawks. So if it does come out with a little bit more of a dovish stance to it, with where the dollar index is trading at right now, we talked about this in this morning's webinar, you could see some pullback there. So the release is out in just a couple of minutes. If you guys have any questions, trade setups, pairs you want to look at, feel free to let me know. We have a couple of different bank research feeds ahead of us, so I'll be able to kind of give you some reiteration of what they think is going on here. Okay, and again, just under 8 minutes to go. And on the research headlines, guys, you may not have heard or may have heard already, S&P did downgrade Greece's outlook to negative. B rating stays, so better late than never with those S&P downgrades. At least we're on the same page. Question here from Stefan saying, if even the slightest pullback from the hawkish sentiment, do you see a massive squeeze on the euro dollar? I don't think if it's that soft. I don't think necessarily if it's the slightest pullback, I would say, Stefan. I think we're expecting to see that just because of where the committee stands right now as far as the voting side. You have those dissenters who have been fighting to sort of wrap up QE, begin the normalization process. They're both gone, right? So it's likely that we'll see a little bit more of a dovish hint to it. If you're saying if it's hawkish, yeah, no, if it's hawkish, you could for sure. You could see the euro fall right back apart. So remember where we are, guys. The tweet I put out on Sunday night on the open when we were coming off of this major key level at 110.95, which is a 100% extension from the 2011 highs. From where we are, nothing really changes for me. When I'm near-term trading this, guys, everything stays the same unless there's something to invalidate it. So I don't care that we're going into FOMC. At the end of the day, we broke above 112.13. That was the bullish invalidation level. I still think that remains, again, on account of the 2618 from the decline off the highs you made in October. You also had a 618 retracement. This dates all the way back to the lows you made back in 2000 or the 2000 low. And then obviously the lower median bound or lower median line parallel all coincides there. So Stefan, to answer your question, even if we get a pullback into this region, this is, in my personal humble opinion, the bullish invalidation level. So if it comes out a lot more dovish, let's say, and they say that, obviously the durable goods orders we got yesterday were dismal, but the inflation numbers have continued to be lackluster, guys. I mean, remember, the Fed has got a dual mandate, fostering maximum employment, price stability. The unemployment numbers have continued to surpass expectations from their part. And it's pretty much the focus is on the inflation, which continues to be real lackluster. Now, some of that is due to the weaker prices that we're seeing in energy and crude and whatnot, but it's going to be interesting to see if they feel it comfortable enough to start prepping the markets for normalization, which, in my humble opinion, is the case. But my opinion doesn't matter. What matters is the market reaction, and we'll see how that hits in just a couple of minutes here, guys, just under 5 minutes. Stefan saying, thanks, everything is a matter of degree. Yeah. I mean, again, remember, as we head into this print, guys, here's what the Credit Suisse overnight swaps look like. Credit Suisse overnight swaps, just for your reiteration, again, is just a gauge of what the market is factoring in as far as interest rates from the major central banks. So if we look here at the U.S., there's still a 0% chance we're going to get a cut next month. Okay, or tomorrow, or today rather, excuse me. 12-month out, the expectation is still for 58 basis points in additional rate hikes from the Fed. So this is what we'll be looking at to see any shifts. If the Credit Suisse overnight swaps start pushing this out and all of a sudden you see this 58 dropped into 40, okay, then it's a tell that the market has began to pare back some of those expectations that we might see them move mid-2015, third quarter 2015. Interestingly enough, heading into the RBNZ, there's really not much of an expectation, about a 6% chance that we'll see a 25 basis point cut tonight from the RBNZ. Expectations, 12 months, are looking for 9 basis points lower. So, I don't put too much emphasis on these guys. It is just a sentiment gauge, but certainly can be a tell when you see larger fluctuations. On the Aussie, which will be interesting heading to next week's RBA interest rate decision, market expectations are for a 43 basis point cut to the main headline rate there over the next 12 months. Next week is about a 12% chance for a 25 basis point cut. So with that in mind, we will see what kind of rhetoric we get from them today. Stefan says, your opinion matters to me. I pay for it. LOL. Right on. And you'll always get it, Stefan. I just got to prompt you. So about 3 minutes out here. Ahead of those releases, quick look, guys, at again those 5-minute charts we'll be watching on the euro, not necessarily the euro pound. I don't know why that one's there. There's the pound dollar. Pound Aussie, I'm actually writing a piece on for Daily FX now. That'll be out later today, guys. As soon as we get through the release, I'll show you a sneak peek of that if you have time. And dollar yen, obviously, with the setup we've been working on the scalp charts. Here's what the dollar yen 30-minute looks like still. Whoops, that's Kiwi yen. Still looking for this short to break out too, guys. If the opening range for the week gives us a topside break, I am looking at 88.65. I'm looking at 88.90 as possible entries to get back on the short side. Topside break there, you probably see 90, but at the end of the day, I do like the broader downside sloping sort of trajectory here for Kiwi yen. But dollar yen looks like this. So no trades since what we reviewed this morning. Okay, just a couple of minutes here, guys. So we'll go through and we'll give you the highlights that are hitting the terminals first. Those will most of the time begin to kind of give us an idea for what the tone of the actual policy statement is, and then we'll take a quick delve right into the policy statement and see what we can ascertain there for ourselves. All right, and the countdown is upon us, my friends. About 60 seconds out. Again, if there are any comments, questions, feel free. Dale says, I'm never on the right side of these releases. If you can get a chance, can you tweet or show the command sequence to access that Bloomberg screen? Sure, please. Garrick, it's CSST space 10, then click Global Request. CSST 10 is the function for Bloomberg. Cheers, mate. All right, 30 seconds out. You can see some dollar taking, or profit taking, giving us a little bit of a squeeze here. So the Aussie dollar upside, the euro dollar upside will be the go-tos on a weak dollar story. On a strong dollar story, I wouldn't necessarily still be too interested in the euro just yet, but here's the release, guys. Just 5 seconds. Kiwi dollar also, watch for the downside there if we do get a break on dollar strength. Okay, Fed policy assessment, inflation to rise gradually. Policy assessment to weigh international developments, leaves federal funds rate target between 0.25%. Repeats, it can be patient to start raising rates. So a little bit more of a dovish tone. But nonetheless, you're seeing the initial reaction here for dollar strength. Just keep on board, guys. Want to wait this out and let the dust settle. It says Fed expects inflation to rise gradually towards the 2%. Fed to conduct term RRP tests in coming months to test the term. By the way, that's the reverse repurchasing agreement as an additional policy tool. Vote of 10-0 for Fed funds rate action. Keeps Feds at 0.25%. We said that. Energy price declines have boosted household purchasing power. Fed expects inflation to rise gradually towards the 2% over the medium term. Inflation anticipated to decline further in the near term. Survey-based measures of longer-term expectations for inflation remain stable. The market-based inflation compensation measures declined substantially, and inflation has declined further, largely reflecting energy price decline. So we talked about that earlier here, guys. This seems a little bit more dovish than hawkish, which is why that initial reaction there that saw dollar strength, I'm very timid on. To keep on going here, it says labor market conditions have improved further, quote-unquote, strong job gains. Economy expanded at a solid pace. That's a quote on solid. It's the first time we've seen them note something to that magnitude as far as qualitative. Fed pledge signals no rate increase until at least June. Fed maintains a pledge to be patient in the beginning to raise rates. So that's sort of the main headlines you've been seeing hit the wires right now, guys. Dollar yen looks like a split decision so far. The index is what I'll be focused on as we continue to pull off that major high we talked about in this morning's webinar. And on the 5-minute charts here, if anything, I would expect to see that we could see the dollar take a little bit of a back footer here. Quick look back at the CSST, see if that Credit Suisse swaps have changed at all. Okay, no change. So again, if we look at the Credit Suisse overnight swaps, guys, no change here as far as the 12-month expectation. So obviously there's still no change to that, but the 12-month expectation is holding steady at 58 basis points. This 10 here means that that 58 basis point is reflecting a change of 10 basis points over the last few days. So right off the bat, it looks like market expectations were increasing heading into today, the amount of interest rate hikes we expect from the Fed. I don't think that this policy statement necessarily confirms that. Here's what the statement says head to toe. By the way, if you'd like to follow along and read that statement for yourself, guys, the link is provided for you right in the chat box below. But it reads as follows. Information received from the Federal Market Committee in December suggests that the economic activity has expanded at a solid pace. Labor market conditions have improved further with strong job gains and lower unemployment rate. On balance, a range of labor market indicators suggest the underutilization of the labor market's resources continue to diminish. Household spending is rising moderately. Recent declines in energy prices have boosted household purchasing power. Business fixed investment is advancing while the recovery in the housing sector remains slow. Inflation has declined further below the committee's long-run objective, largely reflecting declines in energy prices. Market-based measures of inflation compensation have declined substantially in recent months. Survey-based measures of longer-term inflation expectations have remained stable. Consistent to the statutory mandate, the committee seeks to foster maximum employment and price stability. The committee expects that, with appropriate policy accommodation, economic activity will expand at a moderate pace, with labor market indicators continuing to improve towards levels that the committee judges consistent with its dual mandate. The committee continues to see the risk to the outlook for economic activity and labor markets as nearly balanced. Inflation is anticipated to decline further in the near term, but the committee expects inflation to rise gradually towards 2% over the medium term as labor market improves further and the transitory effects of lower energy prices and other factors dissipate. The committee continues to monitor inflation developments closely. Here's the meat of it. To support continued progress towards maximum employment and price stability, the committee reaffirmed its view that the 0 to 0.25% interest rate target for the federal funds rate remains appropriate. In determining how long to maintain this range, the committee will assess progress, both realized and expected, towards the objective of maximum employment and 2% inflation. This assessment will take into account a wide range of information, including measures of labor market conditions, indicators of inflation pressures and inflation expectations, and readings on financial and international developments. Based on its current assessment, the committee judges that it can be patient in the beginning to normalize the stance of monetary policy. However, if incoming information indicates faster progress toward the committee's employment and inflation objectives, then the committee now expects the increases in the target rate for the federal funds rate are likely to occur sooner than currently anticipated. Conversely, if the progress proves slower than expected, the increase in the target range will likely occur at a later than currently expected. I'm not going to read the rest because it's all fluff, but guys, that's pretty much the status quo, okay? Don't necessarily think there's any major shift to expectations of Fed tightening this year. Remember, they keep it open. You know, although they've been arguing that this is more transparent and they're trying to be as transparent as they can, this is pretty much as wishy-washy as it gets. Do you know what I mean? If things get better, we'll raise sooner. If things get worse, we'll raise, further out. That does nothing to give the market indication. That does nothing to give market expectations of actual Fed funds rates. So this is the result. Okay, it's neither as bearish, I think, or as hawkish, or as dovish as people would have expected now with the new policy or committee count. But at the same respect, it keeps that ability for the Fed to do essentially whatever it wants, raise now or raise later. So on whole, guys, it's pretty balanced from my take here. Let's see if there's anything else hitting the wires to suggest otherwise. U.S. stocks extend gains after Fed statement. Dow Jones up 65 versus up 34 previously, so we did see risk take a step higher here. And the 10-0 vote really suggests that everyone's on the same page there, guys. Mike, had a stop on Euro-Yen short at 133.20. Didn't get hit even though it went through 133.03. I'm glad it didn't, but is this normal? Okay, I think you have a typo there. I think you mean it went through 133.30, not 03, because I was trying to understand what you meant. Yeah, if it went, it could be just the spreads blowing out. When we get these releases, guys, it's very, very regular on even institutional desks, even when we were trading on the managed accounts from the future side, or whether it's an FX brokerage. Liquidity is always going to be an issue, and sometimes the spread widen out. Oh, Pooja says the spread was wide, I think. Yeah, so Pooja just giving her 2 cents as well. It's probably what it is, Dale, on that front. Okay, but again, I'm a little disappointed that we really didn't get the lackluster, or didn't really get the moves that we're looking for. Remember, the base case scenario heading into this, guys, was dollar weakness. So that's what I'm going to move forward with. I don't think this changes anything. The technical picture still looks pretty toppy for the dollar near term. So I'm still a favor of the dollar-yen short. I'm still a favor of the euro-dollar long. The com block not quite as well, it looks like it's starting to pan out here at least. Okay, so the euro range highs for the session of the U.S. trade, guys, come in right around 113.65, where it looks like we're pushing through it now. So if that does break on essence in its own right, the U.S. opening range would be constructive there for the euro. Here's what the scalp chart looks like from what we were looking at this morning. Okay, coming into this, we're looking at 113.20, 113.18 as near-term support. The trade remains constructive, in my personal opinion, above 112.18, 112.20. We talked about that. Momentum signature here, even on the attempted break below near-term support. Perfect bounce at 40 keeps the objective on the long side, and in fact, looks like you might have a trigger that's in play right about now. Stops would have to be against this swing low for the 30-minute candle here. Break above 113.92, you look for 114.56. Now, that is larger than the 35 pip ATR we would be looking at per scalp. So just keep that in mind, guys. It's okay to ride out the trade. You always want to hold on to those winners. But, as if you're adhering to my strategy at least, at 35 pips, you need to do something. You don't have to close the entire trade, but to make sure that you're doing something to wrap that up. As a disclaimer, I haven't taken anything, guys. I'm unlikely to actually take a position right now. I'm not really convinced that we saw such a huge discrepancy from what the markets were expecting as far as the release here today. A lot of times we'll have to let the dust clear, the clouds settle here, and we'll see what Asia Pac does for some of these majors here. Okay, so it's still the level to be here for the pound as well as that 152 handle, just above 152.05 or so. Gert says, hi, Mike. If you have a quick minute, look at U.S. oil. I have Andrew's pitchfork from said dates. Let me bring that up for you. No play on gold even. That's to tell that the market's not really moving on this news. What are we looking for here for Gert? What was that? Oil. Okay. He says, I have Andrew's pitchfork from 115. Okay, what time frame are we looking at? Probably 30-minute? $115, $120, $122. $115, $120, and $122. Gotcha. I'm with you. Looks beautiful. It's exactly what I'd be working with. Right on. Right on. Now, what you can do, and again, this is something, take some practice, but you won't hear this on the Andrew's Pitchfork courses that you see online or anything, but, it's a study of slope, guys. So what we do is we just mirror that slope, okay? And if we mirror it to the inside, a lot of times you'll find that these will also continue to catch levels on their own, especially for major highs, major lows. I'll show you one in what pair was that I was looking at today. One of the dollar crosses in a moment. But in general, that's what I'd be working with. Looks good. Looks good. The problem with this, Gert, and what I said earlier in the webinar this morning when you guys were asking about it, is that I think the crude trade's a little stretched here. So it's a downside bias. It's a descending pitchfork. So you're obviously looking lower. But that 1998 sloping line, actually, that broke. If we stretch this out and it snaps the reference points, you'll see that that actually broke. La-di-da-di-da. There it goes. Okay, and the fact that that 47.70, 47 level was so huge has me a little concerned of trying to press any fresh shorts, even on a scalp basis from here. The snapback is likely to be pretty wicked on this, A. And B, you've been getting some ongoing divergence. Ever since the low in December. Lower low, lower low, lower low, on a close basis, right? Lower low, series of higher lows. So for me, when the daily chart is blatantly against what the near term is saying, I kind of will just take a side seat. Does that make sense, Gert? As far as the validity of the pitchfork you're using, right on. I don't see any problems with that one. Good eye. He says, cheers, Mike. Missed that earlier session. No worries. By the way, guys, we're pros at remembering to record now. So for any of the sessions, you will see them recorded. Okay, let's take more of your questions here. Gert saying, looking at a take profit of 43.15, stop at 46, entry of 45.56. Yeah, you could. I wouldn't let me take a step back. I'm trying to say too much. I couldn't even get it out. Gert, for me, all the profit targets for scalps are going to be on the inside. So if we take this quick measure right here, this actually puts the pitchfork right around 43.20. So I put my levels on the inside. I'd have it, right around 43.30, 43.35, 15 pips out. Just remember that you don't, and Gert, I can't necessarily tell you not to do this if it's working for you, but for me personally, I'll never take a scalp into a fresh low, per se, unless that low is broken. Do you know what I mean? So even with the entry on that one, if we just hold the lows so far for the year, you're not going anywhere. Do you know what I mean? Whereas if entry was somewhere around here and your target was the lows, that makes sense, a test of the target. But I will never take a scalp on a determinate break through or that necessitates, rather, a breakthrough support or resistance. So just a quick note. Hope that helps. Adria says, yes, I live for recordings. Hey, Kurt says, noted, thanks, and more than welcome. Sandeep, could we take a look at dollar yen? Any ideas? So dollar yen, I'm still favoring the shorts, really. We reviewed this in this morning's webinar. Oh, okay, and that's a definitive move right there. So let me bring up the near-term charts once more real quick. So here's the dollar yen. The thing that you want to play on these types of moves, guys, is this is where you want to utilize the session opening ranges, the daily opening ranges, and trying to ascertain what the market's doing on an event risk release. If we take a look at this and we bring up the trade sessions indicator, here is the open of U.S. trade. Okay, so the U.S. trade opening range high was right here at 117.90. Okay, trade session opening range U.S. low was right here at 117.65. Okay, once that range gives out, just for the session of U.S., you have a directional bias. The fact that we cleared and tested the opening range high and that held, we're breaking the opening range low right now, gives us a near-term downside bias heading into the end of the session for U.S. Does that make sense? Let's bring up the 5-minute. Okay, we're testing the this is the European lows. Okay, so here's the opening range U.S. high. Here's the opening range U.S. low. Here's the open of U.S. trade. Okay, so if we just remove this indicator now, that's your opening range for U.S. 117.92, 117.63. As long as we stay below this, you look lower. Objectively, guys, this is a study of price action, pure and simple. I'm not talking about trend lines. We're not talking about Fibonacci. We're talking about just pure price movement. So for me, near term, I'd want to be bearish against this high, okay, while below 117.65. If we break back above this, it doesn't necessarily mean you're bullish. It just means you're not bearish. Very big difference in that. It's the break above 117.92 that would put me more in a constructive approach heading towards the Asian session tonight. Does that help? Guys, quick note there. So also one thing you want to note while we're trying to make these assertions on what the market reaction is the high and low that we set for the opening range of U.S. has been accompanied with a 40-60 hold in momentum. So even once price clears the opening range for the session, we want momentum, likewise, to clear that 40-60 range. Okay, so that's why for these trades, guys, a lot of times someone will ask me, are you trading FOMC, are you trading NFP? Sure. But the trade might not come for an hour afterwards, even. Okay? It really depends. A lot of times what the release will do, guys, it'll set the parameters for what the trade will be. Does that make sense? So when the market reacts to the data comes out on a release, you see a higher low set or a challenged higher low set. Now you have the parameters by which to say, all right, if this level gives out, we're done. We're looking this direction or vice versa. So I hope that gives some flavor there. So this is a perfect example of why, you want to be a little bit more cautious. It looked like it was breaking the opening range. Momentum at the time looked like it was below 60 or 40 rather, but the candle close hadn't materialized. And here, as the candle closed, that last 5-minute candle, we held 40 support. So I'm not really sure, guys, that there's necessarily, going to be a play on this release. You got to keep in mind that we still have major event risk later this week on Friday with the fourth quarter advanced GDP read. Remember, the third quarter read gave us a 5% growth in the United States. So certainly expectations for this read are not quite as high. But if there's any downward revision, that's the biggest risk for the dollar. So let's take a quick look at what the event risk looks like for the greenback heading into the end of the week. Obviously, next week, tomorrow, initial jobs claims not that big, but pending home sales with what we've seen the Fed continue to suggest that the housing recovery remains lackluster. Here's the main event for the week, now that FOMC is out of the way. 5%, okay? Not necessarily going to be the 3.1, but if this 5% is reduced to anything, again, this is just conjecture, but anything sub 4.5%, I think you see a major reaction in that maybe the economy is not quite at the strength of the trajectory or glide slope that the Fed would need to feel comfortable beginning the normalization process. So we'll see if there's any downward revisions to that 5% number. Obviously, the 3.1 expected, we'll see the variation off of that. But even so, that day you still get the University of Michigan confidence survey on Friday as well. 98.2 was, if I'm not mistaken, a pretty recent high. I don't think we've seen that since 2005, was it? 98.3. 2003, literally. Okay, so you're basically looking at like a 10-year high in consumer confidence as you head into that Friday print. So you could see a scenario where either you stronger print on GDP and a stronger consumer confidence gives the dollar the push it needs to get through this resistance level, i.e. the highs they made in 2009. Keep in mind, again, the upper median line parallels right there. So the implications on a push and a breakthrough 11,850, it's pretty big. Okay, we're not going to be talking about a little blip here. If this gives out, especially on a weekly close, you're looking much higher. My next level isn't until this major, longer dated 100% extension off the lows from 2011. That's like 12,050. So major resistance here as we head into that Friday print for the greenback. On the flip side of that, again, if it's a miss on GDP and consumer confidence comes off those highs, that'd be a perfect recipe for a little bit of a correction here. One thing we want to start to look at, guys, and it's always important to put things in perspective again. My expectations, Jamie's expectations, what we hope or think is going to happen doesn't mean anything. Well, all that matters is what the technicals are telling us. And right now, as you head into that release, you have to keep in mind that the opening range for the month, objectively, for the dollar index, broke to the upside right here on the 22nd. And the dollar's been rallying way longer, but a pure price action study, keeps us constructive above 11,700. Well, it just so happens that over the next couple of days, that also coincides with a nice basic channel support of October. So this is the invalidation level, and this is what, in my mind, would give us conviction or validate a near-term turn in the greenback, or this is specifically the Dow Jones FXCM dollar index. All right, so some proof of thought there on the dollar. Garrick, great to see you in the room, sir, says, haven't caught too many of your webinars. I'm familiar with Jamie from JS Trade Desk. Is there any particular place where you discuss your trade hunting methodology in detail and the overall strategy? Garrick, I've done daily webinars on Daily FX for the last 5 years. I can't necessarily say there's a specific one that goes over the entire strategy. We do a webinar every morning here, Tuesday through Thursday, Eric, on SB Trade Desk at 8:30 Eastern, where we go over all the scalp setups that you'll see featured on the scalp page. I definitely encourage you to come to those sessions. Let me know if you have any specific questions. You're in the right place. There was a series of strategy recordings I had made back in 2010, but they've since been removed from YouTube, Garrick. So I haven't necessarily gotten a chance to make a whole new how-to movie yet, but Garrick, the strategy sessions are there for your benefit in the morning, so definitely, feel free to let me know if you have any questions on strategy or anything as far as that's concerned in those sessions. We're here right now, Garrick. If you have any specific questions, feel free. Where do you get that trade sessions indicator? Dale asked. I'm not sure if it's FX Codebase or fxcmapps.com. I'll find out for you in just a moment, buddy. There is one on FX Codebase. I'm not sure it's the same one I'm using. New high in dollar CAD. A quick note there from Alex. Yeah, listen, dollar CAD I haven't touched in months, I want to say. If you guys recall, for those of you who've been following me on Daily FX, back in November, we actually took a pretty strong stance to try to play the downside of dollar CAD. That was after a complete. Oh, it's right here. That was after completion of a nice sweet 1618 extension off the low. You had a nice high to trade against, and it didn't pan out. I mean, don't get me wrong. The scalps did all right for the majority of the month because everyone was trying to get long and their mother on every pullback to the dollar CAD because it's such a stretch trade. But that was the last time I traded it, to be honest with you. The breakout of the opening range for December had me on the sidelines, especially the way December closed. This month, I'm not even going to try to counter trend trade that, and even on the pullbacks, they've been so narrow and short-lived that there's just been no conviction on my end to try to trade this. So, you know, the upside targets from here, guys, are far in between, especially for a scalper like me. There's nothing in near-term price action or historic data for me to actually point to for reference. You know, maybe 126.45. Obviously, the 2005 high, just above that, comes into level. It's tough. For a scalper on a trade this stretched, guys, it's just gambling. You're just trying to chase. So I'm going to default that to, you know, the swing trades. Not really my cup of tea at these levels. Once we make a high, see some consolidation, get some back and forth action, I'm all on it. I'm all on it, Alex. But on a stretch like this, man, you know, trying to scalp it is, I've been burned doing this a lot, let's just say that, early in the career. So I don't really want to necessarily stress that right now. Hey, Dale, it's in fxcmapps.com. If you're looking for those trade sessions indicator. Hope that helps, brother. Oh, Gert and Adrius answered that question for me earlier. Geez, I should pay more attention. Sorry about that, guys. I appreciate that. Garrick says, cool. I will try to rewatch them each day. Cheers, mate. And again, feel free, Garrick, in the webinars to shoot any questions, anything's on the table, guys. Nothing off limits at SB. Sandeep says, yep, I see the pick got into a short at 118.20 and considering to close it at the CMP. I think you mean the center median line parallel. I mean, don't get me wrong. I'm favoring the downside in general for dollar CAD. If you guys remember, or if you go to the intraday page, we're, bearish. The invalidation level was brought down to 118 again. So as long as we stay below this threshold, which again will necessitate a break back above the lower median line parallel, that helps. That helps. Let's see that 40 break in momentum, both on this 30-minute chart and on this 5-minute chart. It looks like we'll get it. Again, any stops you take, guys, should be against that swing high. I know it's a little bit farther out at this point. If you miss the initial break, don't chase. Wait for the pullback. It's going to probably test that opening range again as resistance, and that's when we'll get the entry to get back on the shorts here. Looking through some of the other scalp setups we've been following, the euro dollar, we're still waiting on a range break, either sub 113.18 or above 113.85. Aussie dollar. I don't think I even have that set up. Nope. And here's a quick look, guys, before we end the session. On the scalp report you'll see published on Daily FX later today. It's on the Sterling Aus. Listen, it's been a great trade. At the end of the day, we're back at the resistance level that we looked at late last year, okay? We're still within the confines of this nice ascending channel formation, and the break that we made earlier this week above the median line has us constructive near term above the 190 handle essentially. Now, the opening range for the week is what's in focus. Today constitutes an outside day reversal, meaning we've taken out yesterday's highs, we've taken out yesterday's lows, and the candle is a down candle. This is after a 3-day stretch to the upside into an exhaustion range, okay? 191.84 is the 2014 high day close that was made in December. And 192.25, well, that's just a basic 38.2 retracement from the decline off the highs that you made in 2008. Okay. Also, keep in mind that that same range, guys, of resistance where we are right now is also the high that we made last year in 2014 before that final December push. So either way you look at it, the focus right now is on the weekly opening range, which is taking shape just below this rate. And here's what the scalp setup is going to look like. Okay, so here's your weekly open. Your weekly high came into the 88.6 of a near-term decline. That's 91.95. The opening range low came in at the 618. That's 89.36. And basically, the focus is on a break of the weekly opening range. Okay, a topside break. We're still in the confines of this nice ascending channel formation. Okay, or ascending pitchfork, whatever you want to call it. If we break through the upper median line parallel, we're looking on the run right into the stretch highs from last year, 93.05 to 93.27. And if that breaks, guys, it's really open. Open realm. There's a lot of room. There's a lot of room. Initial soft targets at 95. And you really got to go to the daily chart to find anything beyond that. A longer-term prospect does put into view 96.92 and a 100% extension at 97.50. Okay, so you're coming to a major area of resistance. Bottom line, if the opening range for the week breaks to the downside, we're playing those shorts back into lower median line parallel, back into 87.65. A topside break, you got targets at 93.25 and yonder above. Remember, if the range seems big and you're probably asking yourself, what the hell are you talking about, Mike? This is not a scalp. Guys, this is one of the largest ATRs at 226 pips on a daily basis. Okay? So it is a wide range scalp, and per scalp, you're looking for about 57 pips. So there's room. The opening range is big, but so will our profit targets be as well. So I just wanted to give you guys a heads up. This will be published in probably about 30, 40 minutes here on Daily FX. I will tweet it on SB Squawk. And we will put the scalp chart on the intraday trade so we can follow this one as well. Brian C. says, do you give more weight to the natural day opening range or the session opening range? I know people build systems just around opening ranges, Brian. So yeah, Brian, I just want to say one thing. All the tools that I use as far as scalping are taking at face value, okay? So for me, I will never take a trade just based purely on opening ranges or purely on a trigger break or purely on a divergent signal. All those need to mesh together, okay, to make a trade, guys. So, when someone says, we just broke the opening range, are you long? I don't know. Is there a trigger break there too? Is there a formation or divergent momentum that's adding to it? Did we just clear a major key trend line or support or resistance? So I don't necessarily add more weight to this or more weight to this, Brian, is when that occurrence is happening, when I see a session opening range break or a daily opening range break, what's price action doing? Is there something here that's telling me something besides just what the price action is doing or besides just what the opening range is saying? Does that make sense? To answer your question bluntly, though, Brian, I do put a little bit more emphasis on the opening range for each session when intraday trading, okay? I don't really use a natural day opening range per se, Brian. I like to use the session opening ranges. Then beyond sessions, I typically will go right to the weekly opening range, meaning you look for that Monday, Tuesday range to set some sort of high-low for you to work off of. To go even granular to that, to add to that comment, Brian, you can go into hourly opening ranges, and that's something I actually do pay attention to when I'm in the trade, right? So if I'm in a trade and I'm holding a long, and the long is coming into resistance, next hour is here, there's no reason for me to get out, but now all of a sudden the 3 o'clock hour opening range broke to the downside. well, then I start to bring up my stops to the next levels and kind of preparing for a possible turnover. So you can definitely, take that strategy to all different types of. You can go as granular as you want, Brian. It's been definitely a benefit to my trading over the years. So hope that helps. Good question. He says, okay, cool, thanks. Yep. All right. Chris says, do you discuss specific entries, exits like Jamie does? I understand you're working a shorter time frame. Yeah, Chris, so we can't necessarily do it, guys. I would love to. I got nothing to hide. I just can't necessarily do that on a scalp-to-scalp basis, and here's why. Look, these levels are here for your benefit, guys, and you can use them in such a plethora of different various ways. You can take a wide array of different stances using the levels I provide. Someone who, for me, I might be looking for a short exposure here. Someone else might be long with a break of one opening range, so they would be looking to close positions there. With the same respect, the near-term nature of the strategy, guys, there's a lot of times you need to make split decisions and sort of adjust, tweak what you're looking to do. And for me, guys, to effectively trade and be able to put each one of those out on Twitter, it's just not feasible. And then it starts to affect my trade, which is going to be bad for everyone, right? So I do give you the bias, the scalp levels, and the invalidation levels. So Chris, you know exactly what I'm thinking, exactly what bias I'm looking to play, and what levels I'm looking at. The entries I will leave to you guys, but again, daily in the webinars, we go over triggers, we go over different tools that we use to try to give us those triggers on entries. So I hope that helps, Chris. I hope that clears up that question. He says, sounds good. Thanks. More than welcome, sir. Dale says, thank you so much. More than welcome to you as well. Got to go. Hopefully see you tomorrow. Take care. Gert, same to you. Where do you delineate weekly opening ranges time-wise? So, Garrick, it's not necessarily, and this goes across the board, guys, with opening ranges. It's not necessarily the time frame that I want to stress the most, more so price action. So, for example, Garrick, if on the open of the week, a high and low is set on Monday, Tuesday, great, okay? But that doesn't mean that I'm going to strictly adhere to that. Here's a perfect example. Monday, Tuesday opening range was set. We blasted through that, so we were looking higher. Does this invalidate the upside of the trade? No. It just suggests that maybe the opening range needed to that Wednesday. So price action is more important. On average, Garrick, from my personal experience, the opening ranges that have seemed to work best are the ones that pan out between a Sunday, Tuesday type of range. So your Sunday sets a low or a high in Asia Pac. U.S. trade session sets the opposite side of that range. And then as you head into the Monday night, Tuesday morning Asia sesh, then you're looking at a range that has more definitive high lows. And typically a late Tuesday break of the range will be what works best for me. But I don't want to stress it. If there's a very clean opening range that sets forth on a Sunday in and of itself, I'll play that directional break. So we just want to make sure that we're stressing more price action than time. So I hope that offers some clarity on that. Adria says, all right, thanks again for all your help. Enjoy your weekend, Mike. Adria, same to you. Or enjoy your evening, rather. Garrick says, yes, thanks. And Chris says, sounds good. All right, guys. So I think I've exhausted your questions here. I hope you found this session helpful. Again, watch the dollar, guys. We're going to look for follow-through in Asia Pac. And the basic theme here is, do we get dollar recovery, or does this leave status quo with nothing changed as far as the outlook is for the greenback? Still trying to get that dollar chart up. All right, so this is what we'll be focused on. And again, the premise since the start of the week, and will continue to be bearish invalidation with a move above 11,854. Bullish invalidation with a breakback below the opening range high for the month, which sets right here. And Chris, as per your question, here's another perfect example of the monthly opening range, right? So this opening range didn't get cleared until the 22nd. So you might be thinking to yourself, Mike, well, that's not really an opening range, right? 22nd of the month is pretty near the close. And that's exactly proving my point. I don't want to necessarily stress the time, more so price. So within the first 10 days of trade, we had set a high and low, but the break didn't come till late in the month. So once that high and low is set, time has no bearing, right? You're waiting for a break above this level or a break of the lows. So I hope that add some more flavor on that front. All right, guys, we'll wrap it up here. We'll be back tomorrow morning at 8:30 Eastern for the intraday strategy webinar. Till then, best of luck trading, and keep on keep on pat. Anyone who's trading Kiwi, guys, in just under half an hour, you're going to be heading into that RB and Z interest rate decision. Again, we'll try to keep you updated on Squawk if we take any positions on that. Have a great session, guys. We'll see you tomorrow morning. Cheers.